Sanjeev Prasad joins us now. Let's connect with him. Sanjeev, good morning. Thank you for joining us. Singapore or Mumbai? In these days in Zoom, we can't figure out.
It's Mumbai as of now.
How was the Kotak conference, Sanjeev? I mean, I just heard some fantastic, things about how FIs are super excited about India. They want to be in India, but they are really finding that cheap or that value idea.
So the conference was great. We had massive participation, something like 800 institutional investors, almost 200 companies. So yeah, it was very well attended. You're right. I mean, the investors are clearly excited about India, the medium-term, long-term story. But as of now, people are grappling with valuations. So if you look at valuations for the broader market at almost 20 times 1 year forward, clearly not cheap. More important, if you look at the kind of names investor would like to own in India, mostly the consumption stories, investment names, all very expensive at this point in time. So that's the whole struggle. And you also don't have a lot of clarity on the whole macro situation, specifically global interest rates and domestic interest rates as to where they settle eventually. So yeah, so it's a I guess situation where investors would like to increase exposure to India, but are just grappling with short-term valuation as also macro issues.
When do you expect the tide could turn, and what will it take for the tide to turn?
It's just time, I think, to be honest with you. I suppose you still don't have clarity on peak interest rates. Every time, the market makes that assumption that we are near peak interest rates, the inflation numbers come out on the higher side, and then inflation and interest rate expectations move up once again. So if you look at US as an example, the peak interest rate expectation now gone to 5.5%. 9 months back, it was 3.5%. 1 month back, it was at 5%. So that's the struggle. Inflation is turning out to be a lot more entrenched. Core inflation is very, very sticky. If you look at India, early we thought 6.25 was the peak policy rate. It's already moved to 6.5. Now we see upside risk to 6.75 and even 7 now, given a lot of uncertainty on food prices linked to the somewhat, or at least as of now, shaky outlook on monsoon. So unless you get this clarity on the peak interest rates and combine that with very high valuations for most parts of the market, it's just a struggle for the market.
Sanjeev,
so 800. We could see earnings upgrades in this kind of a market environment, which means hopefully the market just goes through a period of time correction. Valuations start looking better over time. Maybe that's when interest starts coming back.
So Sanjeev, 800 fund managers came to the conference. All of them are coming to India. They're liking India, but yet they're selling India. Last year, FI flows were negative. This year also FIs are negative. So I just fail to understand that you like India, you come to India, you spend time, you meet Indian companies. My friends tell me that all of the Indian corporates who come to these conferences, the demand to meet them is high, it's a house full. And yet every time they go back positive, but what they do is actually negative.
I guess just the constraint of valuation at this point in time. See, until recently, you also had this option of China, right? You had the China reopening trade. So a lot of foreigners were participating in that, simply given the valuations were too low in China, let's say 2-3 months back. But of late, even that trade has started to cool off a little bit post this whole balloon episode in the US. So again, geopolitical tensions have come to the forefront, which has dampened, the spirits of some of the investors who are looking at China more favorably. But at this point in time, it's not as if, they will look at India more favorably just because they're not looking at China that favorably. I mean, the valuations are the stumbling block over here. You just can't get away from high valuations. So as I said, we just need a period of time correction. Hopefully, we don't see a major price correction. And 6-9 months later, valuations start looking more reasonable. And, the medium-term story of India is absolutely great, So investors will probably start biting the bullet at somewhat lower valuations, I assume.
Sanjeev, Hi, this is Anisha also joining in the conversation. I want to get your take regarding the IT sector because I was at the NASSCOM event yesterday, and while there was a lot of positivity about medium term, there were murmurs that near term there is a lot of delay in decision making and there is going to be a lag impact that will definitely come to India. Would you concur with that view?
Yeah, I guess so. See, the challenge as of now is the stock prices seem to be factoring in some sort of, I would say, a modest slowdown, not a big slowdown, or God forbid, a recession in the US. If you look at the commentary from the IT companies, it's mostly, about, shallow sort of slowdown. Somewhat muted demand environment, but nothing, very alarming at this point in time. So most companies are still of the view that they will get to mid-single digit to as much as, almost double-digit kind of revenue growth in the next financial year. So far, not that bad, I would say, the demand outlook. But the challenge is the US economy still continues to be very, very strong. Labor markets are very strong. So the challenge for the US Fed is, it has to probably keep raising rates for some more time. We may be getting to the end of the interest rate cycle, but I suppose we'll have to take it up to 5.5. That's what the market is assuming anyway. And probably keep it at those levels for a longish period of time, just to pull off the labor market, which is still very, very robust as of now. And, as I was saying earlier, every time we assume we are at the end of the interest rate cycle, things surprise on the negative side. So the question is, how much slowdown needs to take place in the US for inflation to break? That's where I guess the debate is. And ultimately, if it boils down to a situation where the economy has to slow down significantly for inflation to come down, then we have a problem in that case. Because if you look at the multiples of the IT company, they're definitely not pricing in a big slowdown in the US. Most of them are trading at above pre-COVID levels. And they're pricing a reasonably benign demand environment for now.
Sanjeev, hi there, morning. Wanted to get in your outlook on earnings because yes, we did see some earnings downgrades in the previous quarter, but the general sense is that as we're seeing raw material price, fuel costs, etc., easing, that perhaps the next quarter could be quite promising. What are you penciling in?
We are looking at about 15% growth in the net profits in Nifty 50 index for FY24, about 16% for FY25. Yeah, so as of now, it's looking okay. But keep in mind the fact that discretionary demand has not been looking that great for the last quarter or so. So you could possibly see some downgrades in the auto and some of the other discretionary sectors. But other than that, I think we are okay on the earnings part. If US goes through a bigger slowdown, then maybe you could see some earning downgrades in the IT sector also. But other than that, we are quite comfortable with our earning numbers because it's not as if we built in very strong earning numbers anyways. Look at for the banking sector, for example, we have only built in 5% growth in the net profits of the banking sector, that is in the Nifty 50, assuming compression and NIMs. So we have tried to be careful in terms of factoring in some of the risks which we are seeing across sectors in terms of slowdown in discretionary space, let's say weaker NIMs in the case of banks, etc. But let's see, the wild card is clearly the state of the global economy linked to interest rates.
Expect a 5% growth in banking, because if you're assuming that earnings will grow at 15% and banks will grow at 5%, shouldn't it be other way around? Because banks are always a multiplier to the economic growth.
No, this is just an aberration that in FY23 is an abnormally strong year because you had a perfect combination of strong credit growth, massive expansion NIMs linked to the lag effect of increase in lending rates and increase in deposit costs, and very low provisions. Going forward, I would assume you would see some compression in NIMs, as borrowing or deposit costs catch up with your lending rates. And I would assume banks would start making some provisions just to be, on the safer side. It's not as if we are expecting, any issues as far as credit quality is concerned, but probably, provisions may just go up. Banks may create some extra buffers going forward. So that's what we assume for the time being. It's possible, you're right, you could see some positive surprise on the earning numbers of the bank, especially if, interest rates, turn out to be on the higher side for longer. In that case, the NIM compression that we are building in from, let's say, the first quarter of the next financial year, that may get extended by, another quarter or so.
So as you look at the construct of the market, Sanjeev, where do you think markets are still very optimistic about the earnings growth? They are in a denial mode. So we could be in for disappointment as the year unfolds. And where do you think markets have already turned very cautious and very bearish, and if at all the turn of the earnings would be on the upside?
So autos for sure on the first one, where markets have been too bullish for long. Numbers are simply not coming through. Even if you look at the February numbers for the auto company, volumes are very, very disappointing. Look at the 3-year CAGR, volume growth for most of the segments. Two-wheelers is even negative. So there's always this expectation that things would turn around. But, I don't know how long the market can keep making that assumption. If you look at Maruti, same thing, there was a big expectation around recovery in SUV volumes, still not the case. And multiples are actually on the higher side. So I think you could have a situation where here you could not only see earning downgrades, but also, cut in multiples if the earning numbers don't come through. So that is one area where I think the market is looking like it's too optimistic. IT maybe to some extent, because this is an evolving situation, right? People are just taking cues from whatever they are seeing currently and whatever guidance they're getting from the company. They seems to be still suggesting a reasonably benign demand environment. Some slowdown, but not a big slowdown/recession in the US. Yeah. So there could be some downgrades over there too. Although having said that, IT companies do have some buffer because this year at least, the increase in employee costs would be a lot more muted. So also given the depreciation of rupee, they have some buffer for sure. So maybe that, cushions the negative impact of, let's say, a weaker than expected top line growth. And that, banks possible. You could see some upside over there. Other than that, I think we are okay. I don't see, scope for major earnings upgrades for sure in most of the sectors, I would say. Downgrades, maybe some of the other consumer discretionary names, assuming the recovery is, let's say not even two, maybe 3-4 quarters down the line, you could possibly see some earning downgrades over there.
All right, Sanjeev, appreciate your time. Thanks so much for joining in with your take.
My pleasure. Thank you.